Good afternoon, everybody. My name is Katie Ensweiler. I'm the marketing manager here at VonLehman CPA and Advisory Firm. Huge thank you to HORAN and Graydon on their continued partnership on this ERISA series. It has been great. We started it, I think, in the middle of the pandemic, and it's been going a few years strong. So we'll be following up in the coming weeks with our next session that we have planned out. So please be on the lookout for that. The session is being recorded, so in case you miss anything or have to jump off a little bit early, we'll be sending the link to that later on tomorrow. We will also be sending the contact information for our moderator and all three of our panelists, should you have any follow-up questions. If you do have any questions during today's live presentation, please submit them into the chat box and we will get to them as best we can. With that, I will go ahead and turn it over to Janisa, our moderator.
Thanks, Katie. Good morning, good afternoon, everyone. Like Katie said, my name is Janisa Stecker. I am the moderator for today's discussion. I'm an audit manager here at VonLehman, and I work primarily with a lot of manufacturing and distribution clients and heavily with our employee benefit plan audits. Without further ado, I'd like to take some time to introduce our panelists. Jovana, can you go first?
Sure, yes. Hi, my name is Jovana Krajewski. I am also an audit manager here at VonLehman. I have been here for 11 years now. I want to say half, if not more of that time, I have been working in our employee benefit plan niche. My other area is construction contractors. That's what I do during the traditional busy season time. I also co-lead our ERISA niche with Carrie Walls, who you might have had the pleasure of meeting at one of these events in the past.
Thanks, Jovana. Let's see, we've also got Paul from HORAN. Take it away.
Yeah, good afternoon. Thank you. Paul Carl, the man with no last name from HORAN, 36-year retirement industry veteran, the first 8 with the U.S. Department of Labor. John will share similar information there. 27 years working with a variety of organizations of all size with regard to their retirement plans. So thank you.
Great to have you, Paul. And last but not least, John.
Thanks. Hi, guys. I'm John Kirk. I am a partner at Graydon. I'm also the head of our employee benefits practice here at Graydon. Like Paul, I served my time at the U.S. Department of Labor. I only was able to do 3 years. He has a higher tolerance for the government at 8. But I've been doing benefits now for 20 years, all aspects, both retirement, health, welfare, executive comp. So we're happy to have everybody with us today.
Thank you, John. Without further ado, we'll get into some questions, some of which have been submitted ahead of time by our audience members. We'll just kind of go around the room, see who kind of has thoughts, and we'll go from there. Paul, what are your thoughts on ESG investments?
Ooh, we're starting off right away.
Right into it.
So the ESG, first of all, stands for environmental, social, and governance. They are at one time called social responsible funds, but as people have become more cognizant of governance within organizations as well as environmental factors, the definition with them has definitely expanded. I will be the first to admit that traditionally these types of funds may be lower investment performers historically than funds in similar types of investment styles and so forth. But that's not to say that they shouldn't be a part of the plan. It is something that a committee or the primary plan fiduciary should evaluate in conjunction with an investment policy statement. And if there's reason to believe that these, one or more of these funds should be a part of the plan, then put them into the plan.
Great thoughts, Paul. Oh, go ahead, John.
Tag on that. The DOL put out some guidance under the prior administration that says, hey, you shouldn't really consider ESG at all. That then got withdrawn. The new administration put out guidance that sort of implied you should very heavily consider ESG, which then everyone said, well, that's probably not right either. So we're sort of in an impasse there. But to Paul's point, I think there are plans where it makes sense, especially if you're a nonprofit or have a leaning that way. It probably makes a little sense to have some of those ESG funds, investments in your plan. I think it's always something you should consider, just to say you did a special with your investment advisor, have them present, talk a little about, so you can say, yes, we considered all of them, but for our plan, this made sense for this reason, and these didn't make sense for this reason. Especially with the sort of nebulousness of the DOL guidance right now, I think it's always a good idea as a fiduciary to at least say you considered it. That way you can't really be called out either way, even if you don't ever actually adopt the use of those funds.
Great thoughts, guys. Great thoughts. Let's see. What about if our record keeper keeps trying to get us to adopt a self-directed brokerage account option? Is this something beneficial to participants? And if so, should we make them available? John or Paul or Jovana?
I can start, but I'm sure we all have thoughts on this one. Traditionally, plans, it's always been a fiduciary decision whether you offer a self-directed brokerage account. So the fiduciaries have to decide, is it right for our plan to allow participants to have that option? And typically, once you've made that decision to offer them, you were sort of hands-off with regard to all of the investments and whatever they did with those funds. We allowed you to create this option to have a self-directed account. Good luck. And that was sort of it. Normally fiduciaries, as a fiduciary, you're responsible for the investments of your plan and the performance of your plan and the expense ratio and everything involved in those investments. Self-directed, they sort of said, all right, good luck. You clearly think you know more and better than the fiduciaries, and so we'll go from there. However, now with some recent guidance from the Department of Labor, they just announced that with regard to cryptocurrencies, the DOL announced, hey, we don't think you should be investing in cryptocurrencies. But if you do, you're going to have to answer a lot of very pointed questions about why you did answer it and how you think that squares with your fiduciary duties. So very heavily implying that offering cryptocurrency is a breach of your fiduciary duties due to the volatility. But in that same guidance, they also sort of implied that if your participants have cryptocurrency in their self-directed accounts, you'll be called to answer why that's allowed too. And that's really the first time in a long time, since probably the early 90s, the DOL's really even weighed in on investments in self-directed accounts. So that's a very long way to get back to the original question, which is, yeah, I think they work, but right now, if you want to start one, it's a lot less clear what you need to do with those than it was a month ago. So if you're considering that, very, very carefully consider that as a fiduciary in light of all the recent guidance, whether you think that works for your plan.
And, John, you hit on a lot of key points. And before I touch on those, I'll just back up a little bit. I will say most, if not all, record keepers do have a self-directed brokerage account option available. I would say for the most part, I would prefer not to see it in the plan because it usually raises more questions than answers those questions. Traditionally, DOL guidance has really kind of indicated that if the plan sponsor, the main fiduciary, offers the self-directed brokerage account, that's got to be a fiduciary decision to offer it, but then the investments within the self-directed brokerage account aren't necessarily under the purview or, of the main plan fiduciary. But John, to your point, this most recent bulletin on from the DOL on cryptocurrency in particular, and even referencing the use of it or allowing participants to invest their self-directed brokerage account into cryptocurrency, is really calling into a lot of questions as far as is the main plan fiduciaries, who's most often, the plan sponsor or the governing plan committee. Are they responsible now for these investments in self-directed brokerage accounts? And if so, that opens up a whole new can of worms. One of the things that I think I've mentioned in the past, one of the things I enjoy doing is pulling 5500s off the DOL website and reviewing them and doing kind of my own fiduciary self-risk assessment. And one things I've noticed is a lot of times in self-directed brokerage accounts, there's duplicative investments, mutual fund investments in the self-directed brokerage account that's available in the core investment options of a plan. And the plan generally will have an institutional or a low-cost share class, whereas in the self-directed brokerage account, the participant might not know any better, might be using a broker, an advisor to help in some sort of capacity, and there's some kind of extra fee tied to that share class in the self-directed brokerage that, it's going to, the DOL guidance that came out in March is calling into a lot of questions within the industry as far as self-directed brokerage accounts.
Lots of things to consider there. Lots of things, that's for sure. Both John and Paul, you guys kind of already touched on this, but this came in from the audience, so I'll leave it up to any of you three. Any other thoughts about plan fiduciaries adding cryptocurrencies as investment options to the plan's lineup, or any concerns that maybe they should have?
So Jovana, sorry about that. Vanessa, I have a blog that I write on a weekly basis. I publish it generally on Thursday. So I'll be addressing this in my retirement meditation this week. It's kind of funny. The DOL came out and said, hey, cryptocurrency, we don't think is so good. Then a major record keeper came out and said, you know what, we're going to make it available to our clients if our clients want to use it. Not really voicing an opinion one way or the other. They're just making it available as an investment, although they're not going to use it in their own plan, at least for the time being. So it's kind of interesting. Some senators have jumped into the conversation recently, and the whole reason being is because of the volatility of cryptocurrency. I just read yesterday, Bitcoin in particular, 40% of investors in Bitcoin are underwater right now. So the question is cryptocurrency a regulated enough industry? Do plan fiduciaries and plan participants really have enough knowledge in around cryptocurrency to make appropriate fiduciary decisions? That's my thoughts. John, you have anything to add on that?
No, I think that's right. I mean, especially so several months ago, this U.S. Supreme Court had a decision that was not common to the bond by everything under the sun. Just in a regular old ERISA case no one cares about from the Supreme Court, called Hughes versus Northwestern. And they're talking about fiduciary duties with regard to monitoring funds. And essentially said you have to monitor all the funds, including the fees paid for those funds. And it gets a little technical, but crypto, to Paul's point, is really volatile. And depending on who you invest through, those fees may or may not be considered reasonable when you look at all the other fund options that are out there in the world. So I think any plan, and when they announced, when this broker, I'm going to say it's Fidelity, when Fidelity announced they're going to allow plans to use crypto in their plan, they said, hey, we're going to make it an option, but plan sponsor, the ultimate responsibility to offer it is on you. So they're saying, here it is, hands off. If you want to use it, we will allow you to use it in our platform. And they then said, well, there's going to be a fee of up to 0.9%. 0.09%, sorry. So almost a full point, plus an additional transaction fee on top of that for any crypto trades. So even if you say, I'm okay with the volatility, I want to offer that to my participants. Well, now we're looking at a fairly significant fee for an investment where a lot of people are upside down, as Paul said. So, I think if your auditors or anybody looked at that, that's a pretty terrible investment, and I think you'd be hard pressed to answer how that met your fiduciary duties, at least right now. I mean, we may get to a point someday where Bitcoin is that alternative cash that everybody thinks it's going to be. My son's got like $100 in Dogecoin, so he fingers crossed for him. His meme coin is going to do well. But I think right now it's a hard thing to offer because of the volatility and the fees involved.
And Jovana, how are you preparing to audit this? How would you audit this? Is this going to increase cost to the plan?
We honestly have not had any of our clients add cryptocurrency to their plans. So honestly, I couldn't tell you if that will significantly change our audit procedures or not. But like John said earlier, I mean, if the fees are out of whack, like that would definitely come up during the audit. We do discuss, with the plan sponsors, the importance of their fiduciary responsibility and looking at fees. Does that make sense? But as far as, current clients that we have, this has not come up. So it'll be interesting to see if we do see it more and more this year or in the following years.
Yeah, definitely a lot of volatility there, definitely a lot of risk, and who knows what's going to come of that. Kind of speaking about fees and fiduciary responsibilities, what are some good internal controls that a plan sponsor should have in place surrounding investments? Jovana, can you kind of speak to that?
Yeah, so, internal controls, that's a big area that we focus on during 401k plan audits. So one of the things that plan sponsors should be doing is obtaining SOC reports for all of the service organizations that impact their plans, whether it's their payroll provider, TPA, record keeper. But since we're talking about investments today, whoever the service organization is that handles the investments, the processing of those transactions, definitely get that every year and review it every year. Those SOC reports have really good information in them. You should look at the auditor's opinion in it. Were there any issues with the testing, any deviations? If there were, does that deviation impact your plan or not? Those reports also have a section for user entity complementary controls. And basically what those are is, let's say I have a SOC report from Fidelity and I am a user entity of Fidelity, then they have controls that they suggest I should have in place in order for everything to work correctly. So those are definitely things that in our audit we go over with plan sponsors. The other thing is admin access rights. Who has access to your online record keeping portal? Does that access make sense? When the person with the access is terminated, do you have a policy to get rid of that access, or can they still log in to your plan even once they've been terminated? Management should be reviewing investment activity and meeting with their advisors on a regular basis. Those meetings should be documented in meeting minutes. We've also seen, emails being kept as documentation too. I mean, that's fine. And like we said earlier, definitely benchmarking, looking at the fees. Is everything in the best interest of your participants?
No, I absolutely agree there. As you have those meetings, make sure you document them, because if you're ever audited by the Department of Labor, they're going to say, well, how did you make that decision to offer these funds? Well, this is going to be a meeting from 4 years ago. You're not sure. You may be able to pull some emails together, you may not. So, some sort of, it doesn't have to be in depth. And if you watch some of these videos, these webinars with us before, I've said this multiple times. you just need to have a note of what we did. HORAN came and presented about, the fund performance of these 6 funds. They mentioned that this fund is not doing as well as peer funds, and we should think about replacing it with this other fund that's doing well. The committee listened to their advice, thought about it, and decided to do that. That's all you really need, a couple sentences. But at least if you ever ask, how'd you make that decision? Oh, well, Paul showed up, told us this fund was underperforming. Here's a better fund with, fees are all generally the same. And we did that. It's when you have zero backup for your decisions that trouble happens, and audits take longer than they should, and all of a sudden the Department of Labor is no longer happy with you. The other thing is you should, as Jovana said, have meetings. Don't just get an email from your financial advisor who says, hey, you should do this, and you just reply, okay. Let's see we'll put the thinking cap on just for a little while.
John or Paul, question for you on that. I mean, we see it all over the place. Some plan sponsors, they have annual meetings, others quarterly, some might have monthly. With your experience with working with the DOL, is there something that should it be monthly? Is quarterly okay? Is once a year okay?
I'll say in my experience, I think monthly is probably a little overkill, just as we're looking at fund performance. I mean, you have a bad week and you might start panicking. I think at least, I think you need to have one full-blown meeting at least once a year. Everybody's in the same room and having that meeting. Those quarterly meetings, I think, can be some sort of check-ins. But if someone said, hey, listen, we really need to make a change, then maybe you need to have a meeting at that quarterly check-in. But if everything's sort of going relatively smoothly since your last annual meeting, I think you could have, we had a Zoom call with our investment advisor. Everything's going where we expected it. No action taken.
Yeah, and I'll chime in there too. John, to piggyback, definitely annually. At least one meeting a year annually, well documented, very thorough. I think personally, I think semi-annual's probably the right number for most plans, maybe not everyone, but some type of formal meeting, at least semi-annually or semi-annually. The fact of the matter is, if the advisor's doing their job, they're monitoring investments, they're monitoring the investment markets, day in and day out. That's the job. That's what they're doing. And if there is something that is quote unquote on fire, needs to be replaced, needs to be addressed with the committee or something, that advisor, I know we're going to call our clients. We do call our clients. That advisor is going to do that and schedule something in the interim. The process with a lot of record keepers that often gets overlooked is once a decision is made to replace an investment option, and you replace it with a similar type fund that is better rated, let's call it, and you're removing the other one and you're mapping the funds from the money from the old investment to the new investment, that's a minimum 30, if not 60, 90-day period of time. There's employee notices that have to go out and so forth, and each record keeper has their own procedure. So, what we've come across before is clients' plans with quarterly meetings, there's an overlap that the old fund hasn't been fully replaced and transitioned because of the administration procedures that the record keepers got in place. And we're already having another committee meeting, and it's a little bit confusing. And obviously, it needs to be highlighted or addressed that what's taking place. But
yeah, I just had a client go through that. They're actually moving to a 338 arrangement. So for those that don't know, a 338 arrangement is where you the investment fiduciaries have essentially hired a consultant to be your fiduciary. You've you haven't given up total control, but you've given up pretty much all control with regard to investments, where that investment person will now evaluate the fund and make the decisions, the ultimate decisions with regard to what funds are in your plan. And because of the switch, it's about 60-day processes. They're changing funds around, and twice now they've hit committee meetings where people can't remember which fund is in which plan now. So you meet too often, you do sort of run into that. But to Paul's point, if you have a good financial consultant, when that fire starts, you're getting a phone call. And if it's we need to act today or we need to act very soon, hopefully you can get everyone together to make that decision and then document it. So why did we act extraordinarily outside of a normal meeting? But it's because we had a barn fire.
Definitely. So it sounds just like good documentation is key, and hopefully to keep those auditors, whoever they are, off your back. It looks like we had a chat come in from the audience just now. How often does the DOL recommend that costs are benchmarked versus other providers? Who wants to take that one?
Go ahead.
No, go ahead, Jovana.
I was going to say during our audits, we typically recommend every 3 years you should do benchmarking. Paul or John, I don't know if you have any other time frame that we should be recommending.
We take a look at fees against published benchmarks on an annual basis, but very purposeful benchmarking, somewhere in the anywhere from 2 to 5 year range, just depending on facts and circumstances, what got negotiated to begin with, and what the trend is what is the trend that's taking place. Do we still have the quote unquote race to the bottom? That seems to be over. Record keeping fees in particular seem to have leveled off. And, for the most part, we're not seeing that situation, but it's still good to benchmark. I will say probably 95% or more of our plans that are first onboarding, we've done some type of benchmarking for. And if we didn't do it, it's going to come about pretty quickly, just for the fact that we want to make sure that even if we're staying with that record keeper, they're happy with that record keeper, that the fees are commensurate with the services. So that's one thing that, John, you can follow up with that, but, it's not so much about the lowest cost. It's about the provider and the services being provided, and are the fees commensurate with those services.
So I always think at least every 3 years, you should do a full-blown benchmark everything. Yeah. Potentially even up to an RFP for your financial advisor, just to say, are the fees they're charging us to evaluate our fees correct? I mean, anything the plan's paying for or anything that's being paid for the plan needs to be evaluated. But if during that sort of race to the bottom, as Paul said, people were benchmarking and looking at things almost semi-annually, because it seemed like every time they heard about it, somebody had dropped another admin fee. It had gone lower. That has leveled off. To Paul's point, I always sort of liken the fees you pay to sort of like selling your house. There's I can sell it myself. There's the sort of the flat rate brokers out there, and then there's sort of the full service. And in your commissions, if you will, are sort of all in the place there, but you get different levels of service. Your funds are a lot like that too. I mean, there's some bargain basement fee funds, but you may not have sort of the value and the services your plan needs. So you can't get in trouble for having, you'll never get in trouble for having the cheapest plan, but you may have a terrible plan because it's the cheapest plan. You need to think about, what services are we providing our employees? What services does the plan have? And how does it bring value to the plan? Because, the government, if the DOL looks at you, they don't they're not going to argue that, hey, it's too high. It's too high in light of, competitors and all these other things. If you say, listen, we did this, but we also got X, Y, and Z in addition to these funds, an online portal and a bunch of other things, well, that might make a lot of sense to your plan. But if we find out, everyone else, you're paying institutional fees and everyone else has retail fees or vice versa, well, then you may have some issues that you didn't sort of dig in enough. It's like, it looks cheap, but it's not as cheap as the next guy. And if you sort of turned over 2 more rocks that a reasonable person would have done, you'd see that.
Janice, I'm going to interrupt you really quick. I'm sure everyone saw the chat that came through. Is the use of target date funds as a default recommended? And I'll just kind of put that to all 3 panelists.
I'll start. So the target date funds, these are asset allocation funds that are age-based, generally easy to understand by the participant population. Should they be a default investment option? I don't remember exactly the timing. I'm kind of looking at John right now, if it was 2008, 7, 6, somewhere in there. But, up to that point, default option was pretty much whatever the plan sponsor decided. And most of them just decided to put it in the cash equivalent option. And at some point, in conjunction with some other, regulatory updates, the Department of Labor approved what's called the qualified default investment alternative. And by adding that QDIA, they said that plan fiduciaries would not be necessarily liable for those participants who don't actively choose their investment options. It was prior to that the target date funds were in place. They just weren't gaining a whole lot from a popularity standpoint. But once that legislation and the rules and Department of Labor guidance or opinion or whatever you want to call it, regulation came out, they've taken off. And probably, gosh, I haven't seen any statistics lately, but probably 70–80% of participant assets are invested in target date fund solutions. So that said, are they the right ones for, every particular plan? I would say no, not for every plan. It's a fiduciary decision that needs to be evaluated at the fiduciary level in conjunction with, your advisor, legal counsel, and so forth. So, John, what do you got to add on that?
No, money market was sort of the default there for years, and then interest rates and everything just tanked, and so the QDIA really did help the target date funds grow. Default fund, I can't say I recommend it for every plan. Part of it just depends on the census, the lifespan of your employees. I mean, if you've got an older population, that might not be the best, or it may be the best. And part of it depends on the target date funds you use. I mean, you got to remember they're funds of funds. So it takes a whole bunch of mutual funds, lumps them together, and that's what you're in. And the general goal is it's going to target to be sort of where you need to be when you retire. Well, not everyone retires at the same spot, and everyone has the same sort of tolerance of risk. And you also have to think what they call it the glide path of the target date funds. Some are set up to be the most conservative on your retirement date, and some are set up to be the most conservative several years on after that, which might not work. So, I think they can be good. I mean, sometimes their fees are a little higher than others, especially as a QDIA. You have to look at that, because the employee did not really have a choice and they just got put into this fund. We need to make sure that doesn't have higher fees than sort of other options. It looks pretty bad. You say, hey, here's your default fund. It's a decent fund. I mean, it's set up to be relatively conservative for the retirement date, but they're paying a higher fee. So you got to look at that. I mean, and sometimes, you look at performance and maybe it's just an S&P 500 fund. It maybe sort of makes the right sense for your folks. I mean, that one's really sort of individual to your plan, your people, your census, is to where that should be. But Paul's point, probably 70, 80% are in there. And I think every plan probably should have a target date fund or a set of target date funds, because it really is sort of like the set it and forget it for a lot of people. They can put it in there and it's supposed to be rifle, say, when I turn 62 or 65.
Yeah, definitely from an audit perspective. I mean, I agree with you guys that 70 to 80% of plans that we work with, I definitely see those target date plans or funds, and there's definitely a lot of assets in them. So great questions. There was another question that came in prior to the panel discussion, obviously, from the audience, and I just want to make sure we hit that before we run out of time today. Obviously, the investment market's been quite volatile lately, so what would your guidance be on employee communications to those employees that are afraid of losing their retirement in the market? And how would you combat that? Paul, maybe can you start us off?
Yeah, I'll be happy to. So, people forget that investment markets can be volatile. They especially forget in this most recent, bull market, which technically we're still in. It doesn't feel like it, but technically we're still in a bull market. They forget that investments can head south, right? And they can just start going in the wrong direction, so to speak. The communications for employees should be very purposeful, and they should, while it's good to highlight current aspects of what's taking place in the market and talking about market volatility and so forth, it's more important to be consistent with messaging, consistent in the messages. Highly recommend developing a very, very specific, customized education program, communicating to participants to evaluate, their risk tolerance, their investments, what their goals are. Do this on at least an annual basis. And then frankly, if a participant is doing this due diligence in advance, times like this become less stressful. And if anything else, it's during these declining periods and bottoms that you're actually buying more shares of your investment, as long as you're consistent with the dollar amount that you're putting in. And what you're doing is having what's called dollar cost averaging work more favorably for you. So you're buying more shares so that, ideally that investment turns around and starts heading in the direction we want it to head in, and the growth on the account is much better. So, John, what do you have to add to that?
No, I think purposeful is a good word there. You need to be very, very leery of giving investment advice to your participants. You don't want to say, hey, the market's doing bad, you all need to get out of whatever you're in and get into bond stocks, whatever. Because the minute those go bad, now you, the fiduciary, are very much on the hook potentially for the performance of those, because you've now recommended to the participants that they invest in this particular item. So I think it's more, as Paul said, a robust education program. Whether that's an open enrollment time, a new hire time, maybe just annually have if you're a financial person comes in, sort of does a ABC kind of education meeting for the employees, something like that, so they're educated on sort of the market and how the markets work. Because remember, they really can't get their money out of the plan. It's not like they can pull it out and stuff it under their mattress. Once money's in the plan, it's pretty much in the plan. And to pull the money out will take a significant tax hit, way worse than anything a dropping market would do to them. Because the market's going to come back up, mattress cash doesn't earn any interest. But you can't just sort of panic by saying, hey, the market's doing terrible, you need to reconsider your retirement items. But they can also, and we also don't really want them to quit contributing to the 401k, because that then kills all of our testing and all our discrimination testing and all those things that we want. We want people to invest in our plan. We want them to save for retirement, and we want everyone to put in as much as possible. And as more people pull their cash out, the amount people potentially can put in may drop based on who's participating. So we want people to participate. We want them to, some people will never feel secure in the market, but secure in the plan and in their investment. So I think it's more background education about the markets in general, education about the funds you have. I mean, if you've got 400 funds, well, you probably paralyzed your entire employee group by, they were paralyzed by choice. If you got 4 funds, well, you might want to think about having a few more, because now if we do have a bad spell and those 4 funds aren't set up right, it's going to be a real problem. So, you want to have a good set of funds that the employees can say, oh, well, this one's conservative, whatever, less aggressive, and so they can make that choice. Because for most plans, most employees can log in at pretty much at any time and adjust their investment mix. And so if they're educated on what the funds they have do, they can then make that decision based on how they feel the market is.
We encourage the long-term view, and the long-term view is relative. The long-term view is going to be different for a 25-year-old than it is a 55-year-old, but everyone should be evaluating at least annually where they're at, and so that when stuff like this happens, what we're going through right now, there isn't that panic factor. So, Jovana, sorry.
All I was going to add, no, you're fine, is during our audits, that is something we ask the plan management, is how often do you provide education to your employees about the plan? Some people will bring in their investment advisor once a year, and they might have one-on-one meetings available for the employees, which I think is great, especially in situations like that, where people are panicking. They can hopefully calm them down a bit and explain the long-term impact.
Yeah. Yep. Great thoughts, guys and gals. John, a while back you mentioned if I have a 338 advisor, they're kind of I can kind of take my hands off the investment piece of the plan. So can I kind of rely on them also to help with education for my participants, or what happens if I don't have a 338 advisor?
Yeah, most of the time, most 338 advisors are they're financial advisors. So typically they'll have a full suite of services for education, investment education, those sorts of things available. And a lot of times it's in their services agreement that, hey, we're going to do all the normal sort of financial advisor items, plus for an extra fee, we're going to take on this fiduciary liability as a 338 and actually make your financial investment decisions. Does everyone need one? No, they don't. I think clearly every plan needs a financial advisor. You shouldn't be relying on the CFO or the CEO who think they have a great grasp of the market. You need some of that outside third-party knowledge to come in and tell you, maybe you're doing great, but you need, for a whole host of reasons, including the fiduciary duties, you need that third-party sort of, I won't say stamp of approval, but review. Your auditor can do a good job, but then also you need, the financial person to come in and say, yeah, these funds make sense, these fees make sense, because you yourself don't have a full view of the picture. But you as a committee are relatively financially savvy, and you have a good advisor. I don't think there's any need to take on hiring the 338 or a 321. So a 321 is a lower level, than a 338, but it's a advisor that makes a lot of recommendations, does a lot more. They just don't make the ultimate decision. So review the funds, the recommendations, what to do. The 321 will do that. They just won't then actually effectuate the change, which is what the 338 does. So, if you're going to look into that, a 321, I think is a nice, and a lot of people are doing that these days, is hiring the financial advisors in that capacity to sort of help them with the review. especially if you're a company that you don't really have that financial or investment expertise represented on your plan committee. If you've got a good cross-section of financial people, people with outside investment experience, you got an advisor coming in, maybe you don't need any of that. But I think for most plans, when it's sort of, here's maybe a union rep, and here's maybe some regular employees, and here's HR, and maybe the CFO shows up at the meeting every once in a while, looking into maybe a more in-depth, higher level sort of advisor relationship might make a lot of sense.
And, John, I just want to make sure that everyone caught that. So there's really 3 levels for advisors. There is the full fiduciary investment management level at the ERISA 338 level. And that is, as John said, that's a registered investment advisor, an RIA that's going to be in that capacity. The ERISA 321 co-fiduciary is an investment advisor who's making very specific recommendations. And then, the committee or the plan sponsor, whomever are, accepting or rejecting those recommendations and causing them to effectively happen through their yay or nay. And then the third role or third capacity is the non-fiduciary. And, this is the advisor who can say, hey, this fund is not performing well, and here's some like funds, but the onus on making the decision to make the change and which fund maybe to map it into is completely on the committee. So, HORAN, we generally will work in a 321 or a 338. I can't speak for everybody, but that's definitely been the trend industry-wide, is to take on some type of co-fiduciary, if not fiduciary capacity. So,
Jovana, do you know what the plans that you work with, that the firm in general works with, do you know what capacity they have their investment advisors in?
I mean, I feel like we have a good mixture, but I think the trend I see is that a lot of the plan sponsors might not necessarily know what responsibility they have versus their advisors. So I think that also goes back to the education piece of bringing their advisor in and even explaining to plan management really what does their service agreement mean and what does it all detail out.
Yeah,
but I think we have a good mix.
Yeah. So we're getting close to time, and I want to give everyone a chance for some final thoughts, but I know some things that, I've kind of taken away are documentation is really important about those fees, about the investment lineup. Education is key, both participants and even the plan sponsor level. So John, can you kind of take us away with some final thoughts as it pertains to investments in these plans?
Sure, and I think Janessa sort of summed it up really well. I mean, if you're a fiduciary and you're looking at your investment options, it's all about doing your due diligence, because you as the fiduciary are judged on, did you act like a reasonable person when you made that decision? And so that involves, documenting things to prove you acted reasonably, and, kicking the tires, turning over some rocks to look at things, whether that's you doing it personally or having hired an advisor to come in and do that work for you and then present their findings. But you can't rely on just sort of your, hey, this sounds good, this fund looks cheap, let's do it. That's sort of where you're going to get into trouble. So, it's all about acting as, prudently and reasonably, and using those experts where you have gaps to fill in your knowledge.
Jovana, what about you? What are your final thoughts?
Yeah, my final thoughts, kind of to piggyback off of that, when it comes to investments, don't go into anything alone. There are advisors out there who do this on a day-to-day basis that can help you. And just keep in mind that it is your employees' money and their retirement that you're dealing with. It's not, just the company's money. So definitely reach out to your investment advisors.
Yeah. And Paul, final thoughts?
Yeah, final thoughts, everything that everybody else said so far. It's proper due diligence. It needs to be documented. It needs to be consistent. Don't wait for market volatility to hit before you decide to communicate something to participants. Educate them on a very purposeful and routine basis. Listen to what your advisor is saying, listen to what your attorney has to say, and listen to the auditors. The auditors are kind of that extra, set of eyes that after the plan year is concluded and they're looking through things, the auditors are highlighting certain items that might have been missed or that could have been done better. And while it doesn't necessarily feed into the audited financial statements, there's some best practices that get shared through that. So,
yeah, I would say your auditors see a lot of plans, good and bad, but if you're looking for best practices for like how a plan should be run, that's a good place to start. Is what have you seen that really works, and what have you seen that doesn't, and how do we stack up? It's a nice question to ask your auditors during that time.
Yeah, our audits are very compliance based. We look at, what does your plan document say, and are you following that? So depending on the plan, there might not be any recommendations, or we might have a lot of, best practice, or you need to correct this. So yes, please, take these audits seriously, because we are just helping the plan sponsor at the end and the participants.
At the end of the day, an audit with Jovana or me or whoever your auditor is ultimately going to be hopefully much easier than should the DOL or the IRS ever come knocking. So the best practices given are definitely meant to help you and keep the DOL and the IRS away.
Mm-hmm.
That is great final advice. So a big thank you to Janisa for moderating our panel. I think you did a fabulous job. And Paul, John, and Jovana, great insight, great information. As I said, I will be sending out the link to the recording tomorrow, as well as the contact information for all the panelists. And I did write down that Paul is doing that weekly blog. So we'll be sure to send the link to that one as well, so everyone can tune in. So thank you everybody for your time today, and enjoy the rest of your week.
Thank you.
thanks, everybody.
Bye.